Do you get scared when you think about investing? Or do you think investing is only for the rich people? Or you feel like you don't even know how to get started? Well, you are not alone. Some people, when they hear about investing, it can be truly overwhelming. But what if I told you, just like every other thing you have learned in the past? For instance, learning how to drive a car. At first, you are all tensed up and scared and probably thinking that you are going to die. But little by little, with the right information, you will find out that it's not as hard as you imagined. That is exactly how it is with investing. In this video, we will be covering the basics of investing and why it is important. Secondly, how to invest and different types of investment. Thirdly, alternative way to make money quickly through investing. So be sure to watch until the end. My name is Nedu. Quick disclaimer here, guys. This video is for educational purposes only. Always do a proper research or consult a financial expert before investing. Before going any further, let us try to understand what it means to invest. Investing involves buying something with the goal of increasing your wealth over a period of time. This can happen in different ways. First, by selling the item higher than the price that you paid for it, and this is called capital appreciation, or by earning rental income from it, example, if it is a property, or by receiving dividends if it is a company stock. Ultimately, the aim is to generate positive return on your money and grow your financial assets. Now, why is investing so important? The main reason for investing is so that your money will be able to make more money. In fact, every dollar you have is like a little worker that works for you 24/7 without taking any breaks. For example, if you made $1,000 from your normal 9 to 5 job, instead of putting this money under your mattress or in a conventional savings account, you could decide to invest this $1,000 into a high yield savings account. Those dollars are now actively engaged, working to generate returns for you in the form of interest. Over a period of time, your investment grows, with each of those dollars effectively multiplying. That is the power of compounding. Your money grows exponentially as it generates more money over a period of time. Secondly, why you want to invest your money instead of allowing it to sit in your normal bank account is because of inflation. An example of this is, let's say a tin of milk costs $5 this year, but next year that same tin of milk may cost $7. If you had kept your $5 sitting in an ordinary savings account, then next year you will need extra $2 to be able to buy that same tin of milk at $7. But if you invested that $5, in a few years it would have borne interest and your money would not lose value due to inflation. Before investing, it's crucial that you assess yourself. This process not only helps you to determine if you are ready to begin investing, but also identifies the most suitable investment approach for you. Oftentimes, people jump into investing simply because they see others doing it and it never ends well. It is important to understand your own financial situation, your risk tolerance, and your investment goals to make informed decisions that align with your needs and your circumstances. The number one check is, before investing, you must have an emergency fund in place. This fund should cover your living expenses for at least 3 to 6 months. And in some cases, it's recommended to have up to 1 year's worth of living expenses saved up. Secondly, even though it doesn't require a lot of money to get started, but you shouldn't start investing until you can afford to do so. If you have debts and other obligations, consider the impact that investing will have in your short-term cash flow before putting any money into any form of investments. And you must also think about how long you can do without the money you will be investing, whether you are comfortable not accessing that money for a few years or longer. Some investments are short-term, that is within 5 years, while others are longer, which is 5 years and above. If you are saving up to buy a house in the near future or saving for a wedding, this should inform you on what type of investment strategy to consider. Once you have had all that figured out, then you are set to start investing. There are many different types of investing, but these are some of the most popular ones. First is high yield savings account. This is best suited for short-term investments. As the name implies, high yield savings account is a type of bank account that can pay you up to 10 times more than the interest you receive from your ordinary bank account. And it works just like a normal bank account. You can make deposit and you can withdraw your money at any time you want. And there is relatively no risk involved, as your money is insured by the Deposit Insurance Corporation of your country. It is important to note that high yield savings account options are not limited to only people living in the US. All you have to do is search for high yield savings accounts in your country and find suitable options. If you want to know more about high yield savings account, let me know in the comment section and I will make a video on that. The second type of investing is buying company stocks. This basically means you own a share or a piece of that company and you earn money from stocks through dividends. Most companies pay dividends monthly or quarterly. And also, as the overall value of the company grows, so is your investment in that company. Investing in stock market is one of the most popular ways of investing, and it is best suited for long-term investments. Long-term investing typically means holding onto your investment for a period of over 10 years. Here is why. Let's say you bought an Apple stock today. It is possible that within a year, the stock's value could decrease. And if you decide to sell at this point, you would realize a loss in your investments. However, if you are able to hold on to that Apple stock, there is a good chance that it will bounce back in the future and potentially returning a profit. This means that while there may be periods of instabilities and downturns, the stock market generally tends to increase in value over the long term. This is why it is crucial to approach stock market investing with a long-term mindset. By staying invested through market ups and downs, you give your investments opportunity to grow and potentially achieve significant returns over time. The third type of investing we are going to be discussing is in real estate. Real estate is an investment strategy that can be both satisfying and lucrative. What makes it a good investment is because real estate investing has a high chance of success and a high return on your investment. Unlike other types of investments, you can use leverage to acquire a property by paying only a portion of the total cost upfront, then pay off the balance plus interest in the future. Though traditional mortgages generally requires a 20 to 25% down payment, but in some cases, a 5% down payment is all that it takes to purchase an entire property. Ways to invest in real estate includes owning a rental property. You make money from regular rental incomes from the tenants, and over time your house may appreciate in value, which also adds to your equity and overall net worth. You can also make money in real estate investing by flipping properties. This is where you buy an undervalued real estate, fix it up, sell it at a higher price and earn profits. You can also invest in real estate investment groups. These are a more hands-off way to make money in real estate. An example of this is real estate investment trusts. Now, the alternative way to make money quickly through investing. When most people hear the word investing, their mind often jumps to the traditional ways, which is working a job, saving up enough money, and then diving into the stock market, hoping for a long-term growth that will eventually lead to financial independence at 60. And there is absolutely nothing wrong with that approach. However, there is another alternative, one that can potentially shorten your journey to financial freedom through investing. And it is important that we discuss it here. Let's face it, if you're already in your 30s, waiting another 30 years to achieve true financial freedom can feel like forever. And in life, there is actually no guarantee that you will make it to 60. And that is the reality we all must acknowledge. Here is an example. If you were to invest $1,000 every month in the stock market, with an average return of 8%, in 30 years' time, you would have approximately $1.4 million. But alternatively, if you invested the same $1,000 every month in your own business, giving it the attention and care that it deserves, with the right approach, your business could potentially yield returns of 1,000% within just 5 to 10 years. This method is known as the fast lane approach versus the traditional slow lane method of investing in stock markets and waiting decades for your money to grow. Thank you for watching. I hope I have been able to provide you with some values in this video. Don't forget to hit that like and subscribe button for more content like this one. And if you have any questions, feel free to leave them on the comment section below. Also, let me know what other investing topics you would like me to delve into in depth. I will see you in the next one.